Despite a sell-off in May, the quarter ended with Wall Street reaching new all-time highs, pulling the MSCI World Index of Developed Markets also to new highs. For the quarter, the US and world markets returned 4%, taking year-to-date returns to 18% and 17% respectively. Yet arguably the most dramatic moves were in bonds, where interest rate expectations have been repriced substantially lower in the face of weakening growth, falling inflation and rising deflationary fears. Yields on 10-year US Treasuries fell by 40 basis points in the quarter to 2%, taking the fall to 70 basis points this year. And other government bond markets followed. In many major countries, yields have fallen to all-time lows. In Germany, 10-year yields are negative 40 basis points, for the first time ever dropping below the ECB's deposit rate, with positive yields available only on maturities above 20 years. These are extraordinary moves given how low rates already were at the beginning of the year, and have resulted in exceptional performance from bonds. Global government bonds returned 3.5% in the second quarter, 5.4% year to date, while in credit, corporate, high yield and emerging market bonds all produced good returns in the quarter and of 10% or more so far this year. In remarkably benign conditions with nearly all asset classes up, it was notable that safe haven assets also performed well, with gold up 9% in the quarter and the Japanese yen up close to 3%. In part, that might reflect the deep uncertainty prevailing about the state of the global economy and geopolitics, and in part the longer-term implications of the truly extraordinary conditions in bond markets, now with over 13 trillion of bonds trading at negative yields. While Trump's trade policies and unpredictability continue to unnerve trading partners and investors, it was unquestionably the shift to much more dovish positions by the Fed and the ECB which was the driving force behind markets. The news flow on tariffs and trade was generally unhelpful. The deterioration in negotiations between the US and China, with Trump's sudden announcement of additional tariffs on imports from China, followed by the threat of tariffs on Mexico for the explicit political purpose of curbing the flow of illegal immigrants, spooked markets briefly, but this was far outweighed by the substantial policy shift by central banks. In what amounted to a U-turn in policy, the ECB surprised markets by announcing its readiness to provide additional stimulus, including further cuts in policy interest rates if a sustained return to their inflation target is threatened. Given that inflation in the Eurozone has remained resolutely well below the ECB target of close to 2% since the financial crisis, and it's currently hovering around 1%, the implications are pretty clear. The ECB followed this up by extending its forward guidance, committing to keep rates unchanged at least until mid-2020, combined with a further round of cheap funding to banks and the possibility of restarting its QE program, on hold of course since the beginning of the year. At the same time, the Fed, which has become progressively more dovish since calling an end to its tightening program in December last year, took a further step towards policy easing in the face of rising evidence of slower growth. It shifted its interest rate, inflation and growth expectations lower, with Chairman Powell noting that uncertainties about the outlook have increased and committing to act as appropriate to sustain expansion. Markets priced in between 3 and 4 rate cuts over the next year, a dramatic change of expectations from little more than 6 months ago. Other central banks also eased policy. Australia cut rates and the Bank of England adopted a more dovish approach while warning of falling business and consumer confidence and the increasing threat of a no-deal Brexit. Central banks are reacting to 2 critical developments. First, increasing evidence of a slowdown in growth, and second, a fall in inflation and perhaps more importantly, inflation expectations. The slowdown in growth to date has been largely in manufacturing, with global trade hit by the US-China trade war and the key auto industry facing unprecedented disruption and falling sales. Manufacturing is in recession in Europe and slowing sharply elsewhere, and leading indicators point to a continuing tough environment. To date, the consumer and service sectors have held up well, but there have been some signs recently that confidence is waning, increasing worries that a soft patch triggered by the downturn in manufacturing could become more widespread. The drop in inflation highlights the problem that central banks face. After a decade of ultra-loose policy, inflation in most developed countries remains below central bank target rates. Indeed, inflation in the US, Europe and Japan has remained stubbornly below target rates throughout the post-crisis decade, despite the efforts of central banks to push it higher with unprecedented monetary largesse. And the spectre of deflation remains a worry in the Eurozone and Japan. Despite the strong returns this year and the powerful support to valuations from low inflation and exceptionally low interest rates, uncertainty remains high. Aside from the slowdown in growth, the unfolding trade wars and the negative impact on corporate earnings, other concerns, each with the potential to damage confidence and growth and to disrupt markets, continue to worry investors. With the demise of the disastrous premiership of Theresa May, the UK will have a new Prime Minister within days. Boris Johnson is the near certain winner, and his intent to fulfil Brexit and take the UK out of the EU by the deadline of 31st of October, with or without a deal, has increased the risk of a no-deal exit materially, and with it the prospect of some short-term disruption to trade between the UK and EU. Sterling is already reflecting this possibility, having slipped to a 2-year low against the dollar, but further weakness is likely as the ramifications of the changing leadership are fully absorbed. Sterling assets carry a sizable Brexit discount and do offer the possibility of a sharp rebound once the current uncertainty is lifted. Elsewhere in Europe, the Italian budget dispute with the EU reached a short-term compromise solution, but leaves open substantial longer-term problems. Without great substance underlying it, the populist Italian government agreed to restrain its fiscal deficit to 2% of GDP, enabling the EU to back off from disciplinary action. The ensuing rally in Italian assets took bond yields down by 100 basis points and led to Italian equities and bonds being among the best performing assets in the quarter. Yet with debt to GDP of 130% and an economy which has hardly grown since Italy joined the euro 20 years ago, this is a problem which has been kicked down the road and will come back to haunt investors in due course. A broader but related malaise in the eurozone is reflected in the weak state of its banking industry. Share prices of banks across the euro area fell sharply in recent weeks, taking the banking index back to its crisis lows in 2008-9. The US-Iran dispute, which has been rumbling on since the US withdrew from the nuclear deal, deteriorated materially with attacks on oil tankers in the Gulf thought to be the work of Iran, and increasingly hardline tactics by both Iran and the US. This supported the oil price, as did the extension of production curbs by Russia and Saudi Arabia, but it couldn't prevent some slippage in the oil price over the second quarter after the sharp rise in the preceding quarter. Some caution then is warranted in the short term. Equity and bond markets have risen sharply this year, driven by the prospect of easier financial conditions, and valuations have become stretched in some areas, notably in fixed income. Yet the economic backdrop has deteriorated. Corporate earnings are under pressure, especially in sectors most exposed to manufacturing, and markets are largely discounting sizable policy easing by central banks in the months ahead. However, while trade and manufacturing have been weak, the key service sector has remained firm, employment has been strong, and the consumer is generally in good shape. There are no signs of systemic financial problems and an ensuing liquidity crunch, nor of capacity shortages, inflation, and a sudden tightening of policy. With inflation subdued, central banks have considerable flexibility in keeping policy ultra loose for much longer, thereby extending this extraordinary cycle. Furthermore, the extent of the falls in government bond yields and the impact on financial conditions and valuations of other markets should not be underestimated. US bond yields have fallen by over 100 basis points since late 2018, and this provides strong underpinning to equities and other risk assets, offsetting the more challenging conditions faced by the corporate sector after last year's benign backdrop. While some consolidation is overdue, we therefore believe that the cycle has further to run, and any falls in markets will give rise to opportunities to add to risk assets, while at all times maintaining careful diversification in portfolios to provide protection during inevitable shorter-term setbacks.